Meta shares are currently experiencing their biggest drop in recent months, and what happened was definitely not what investors expected. The share price of one of the largest and most influential companies in the world today has fallen by 25% in the last 2 months. It has thus reached its lowest level since the beginning of May. In recent weeks, Meta has been struggling with high valuation pressure and overall market nervousness, as well as facing several court settlements in which management, including Mark Zuckerberg himself, paid tens of millions of dollars. Investors were also rattled by worse-than-expected quarterly results, which sent the share price down 11% in a single day, and a scandal involving fraudulent and harmful ads that earned the company billions of dollars. Can it recover and find its way back to growth? The whole situation began to escalate with the announcement of third-quarter results, which the company announced on Wednesday, October 29th, after the market closed. On paper, Meta's numbers look fantastic. Revenue is up more than 26% year-on-year, user numbers remain at record levels, the advertising segment remains dominant, and new AI features on Instagram and WhatsApp are increasing engagement. But then came one of the biggest accounting interventions in recent years. The company had to record nearly $16 billion in a one-time tax item resulting from the implementation of the U.S. One Big Beautiful Bill. This expense virtually reduced its net profit to a minimum. Without this item, the company would have reported over $7 in earnings per share, but with it, earnings per share are only around $1. And that was the moment that sparked panic. Investors suddenly saw profits that looked weak, and even though they understand that this is a one-time event, the question of future quarters brought uncertainty. But this was not the only reason why the stock fell. Another, perhaps even more important factor, is Meta's dramatic increase in capital expenditures. The company announced that its investments in artificial intelligence infrastructure, data centers, in-house chip development, and internal AI models would be higher than expected. Capital expenditures are expected to climb to $70 to $72 billion in 2025, and management has indicated that 2026 will be even more challenging. For investors, this means one thing. Just a few weeks ago, Meta was in a situation where its share price was rising in anticipation of innovation, but it is not yet clear how quickly these investments will pay off. And the market, which for several quarters valued Meta as one of the most profitable companies in the world, is suddenly watching a company that temporarily resembles an AI startup on steroids. In the eyes of investors, the company is weighed down by huge costs, huge ambitions, but so far an unconvincing return outlook. On the other hand, it is worth remembering that Meta's shares were in a similar situation not so long ago. Let's recall 2022, when Meta's share price plummeted 73% as, similar to today, its investments in Reality Labs grew. In the end, Meta delivered results, and the shares turned around. However, this is no guarantee that it will happen again this time. And so, another issue that also weakened Meta's shares was litigation. Mark Zuckerberg and the company's management had to approve a $190 million settlement of a shareholder lawsuit for privacy violations. Another blow came from the advertising sector. Analyses by AML Intelligence suggest that Meta may generate up to 10% of its advertising revenue from questionable advertising activities that are on the edge of the legal spectrum. If regulators began to scrutinize this area more closely, Meta could lose billions a year. This is a risk that investors simply cannot ignore. To understand the situation in a broader context, it is necessary to compare Meta with other players in the AI environment. We can find the companies closest to it on Boolios, directly in the stock details. If we look below the fair price, according to which Meta is still overvalued even after its current quarter decline in value, we find a table with equivalent companies. At first glance, we can see that Meta has a much lower P/E ratio than Google and Microsoft, for example, thanks to its current decline. For a more detailed analysis of all the data, which would take a long time, we take a summary from StockBot and get the result in a few seconds, confirming that Meta is still not a cheap stock. Google and Microsoft, for example, have different strategies. Thanks to its partnership with OpenAI, Microsoft is integrating AI into its entire product ecosystem. Google is working intensively on its own Gemini models and strengthening its cloud services. Meta, on the other hand, is investing in open-source models such as Llama and its own AI ecosystem. This has advantages for developers and for the long-term impact of the company, but so far it does not generate direct revenues that would justify the huge expenses. Investors therefore see an imbalance between spending and revenues. When we look at the macroeconomic environment, the situation is even more complex. Rising interest rates, a slowing economy, and increased costs across the technology sector are creating an environment where companies are forced to seek efficiency. But Meta is going in the opposite direction. It is increasing investment, increasing costs, and facing greater regulatory uncertainty. At a time when investors are craving stability, Meta is embarking on an expansionary project, and when this strategy is combined with one-off costs and scandals, it is no surprise that the stock has come under pressure. Investors' views are therefore beginning to divide into two camps. Some believe that the stock's decline is a unique opportunity, because Meta has fundamentals of a completely different caliber than a traditional technology company. It has billions of users, a strong advertising business, and growing engagement. The second group, however, argues that Meta has entered a phase where it is threatened by a combination of high costs, low market confidence, and growing competition with faster monetization models. That is why this sell-off is not just another chapter in the history of tech stock volatility. It is a test of whether Meta can grow in an environment that no longer responds to stories, promises, or vision. The market is now waiting for results, and Meta will have to show that the technological future it is now spending tens of billions on is not just an expensive gamble, but a real engine for the next decade of growth. This video may be ending, but there is still a lot of information about Meta and thousands of other stocks. If you want to pick stocks like a pro and don't want to waste hours of time doing complex analysis of each individual stock, check out Bulios, where you can get a perfect overview of everything you need for detailed analysis in just a few seconds. You can also use StockBot, which will analyze your selected stock in a matter of seconds, so check it out.